Folks, we have the one and only Mr. Real Estate from Fortune and Leo. How you doing, Leo? Hi. How you doing, Lance?
Doing good. Housing. Thanks for having me. And we got Leo here today. He wouldn't stop fussing, so he had to get up here.
Yeah, I love it. I think that's entertaining. I'm going to say hi to Leo the whole time, and we're gonna see what happens. This should be fun. So let's first talk about what's going on in the economy, banks, lending, banking crisis, lending getting tighter, rates, all kinds of stuff. Where would you go first, Lance, in all the craziness of the last week?
Yeah, so I think I would take us back to last year, which is the analysts were saying that the Fed was going to continue to hike until either inflation came down or something broke. And
Yeah.
it looks like maybe we have something that broke with Silicon Valley Bank last week going down with the bank run, some more banks having a little bit of distress. The Treasury and the Fed stepping in to essentially, at least in my mind, what they essentially did is they said, you know what, the FDIC limit is no longer 250,000; it's infinity.
Yeah, it's infinite. Yeah.
And so they're pretty much just trying to create confidence in the system and, to where they don't have any, financial distress
Yep.
in the system. Yeah. And so what we've seen is financial markets now, Leo, you don't stop, you're going down. Financial markets have priced in fewer rate hikes from the Fed. And then also for the future, they priced in the Fed cutting rates sooner than was previously expected. And while the Fed doesn't set the long-term rates like mortgage rates,
Yeah.
those long-term rates do change based on the expectations of where short-term rates will be long-term.
Yeah.
And so the thinking being now that the Fed will go through with fewer rate hikes with the added distress in the system. And so
Yeah.
this is the first Fed meeting where we don't actually have a great consensus on where the Fed's going to go.
Yeah.
It seems like more consensus is drifting towards pause, no rate hike in March, but potentially a hike in May.
Yeah.
Others
I
still
would
think.
I would tell you that would be a gigantic mistake, in
So
my
you
opinion.
think 25?
I think they have to do a 25.
Yeah, 20.
If they don't do 25, it actually sends a worse signal, in my opinion.
Well, and the thing about not doing any is that could send many signals, right? It could be,
Exactly.
hey, are we pausing just because this happened and we want to see where things will be in May? It could also mean to some, hey, this is a full-blown pivot, right?
Yeah,
Some people are
exactly.
all the way there. So we'll see what they do. And I think there's been one firm that says they think they'll cut. If they cut, I
Oh,
mean,
Joe.
it's terrible. That actually would shock me because that would mean that what's going on right now is far worse than we think it is.
Exactly.
That's the only
Exactly.
way to cut, is things
Yeah.
would actually have to be pretty bad. And so it'll be interesting to see what happens with mortgage rates. We've came down from, that 7.05. Today it's like 6.54, I think.
Yeah.
So we've come down a little bit, still kind of pressurized. But I think the real estate industry will take anything they can get with these busy few months up.
Oh, for sure. We're in the spring selling season. Yeah.
Yeah. And,
Absolutely.
the thing about mortgage rates, it's not all about how high they get. It's if there's the volatility and people can lock in at the lower end of the scale before things move up or after things move down. So this spring season, although we've hit 7, we've had many, many periods where people come in far under 7.
Yeah.
So
No, absolutely.
I don't quite know if we have felt the impact of what a 7% mortgage rate would be right now, because so many people have been able to lock under that.
No, you're
So
absolutely right. Seven, we haven't been there long enough. It takes time for that to really have teeth. Just
yeah,
like we didn't have time sub 6, which, we were there for a minute. Right. So
yeah,
it's
and
pretty
some
interesting.
people were getting greedy that day. I saw a few people message me, and we're like, well, I'm just
I'm gonna wait.
Yeah.
Yeah.
It's like,
I have a saying: if you like it, lock it. If the numbers make sense, lock it. You really do adjust your risk profile. So I think it's really interesting. In the last week, we have seen the yield curve inversion de-invert, right? It went from a peak of 108 to, I think this morning it was 54 basis points. I don't know what it is at the moment, but certainly less than 108. I don't know that I've ever seen the 2-year fall as fast as it did, right? The 2-year is now calling the Fed to cut this
yeah.
year, which I think is wild to think about. But I will throw something out there. I think at least in the short term for me is 30 days. I suspect that we could actually see mortgage rates retest 5.99. I know you don't like to make predictions, but I think there's so much fear in the system that generally that it may go that direction. That's something I put out there.
Well, I think the fear, well, I think right now there's just a very big spectrum on where mortgage rates could go versus, a few weeks ago. I mean, there's a lot of uncertainty right now. I mean, we started today and I think the 10-year was down almost 0.1, right?
It was more than that, 0.11. It was down to 3.42. I checked before the call. It's actually up today. It's up now.
We've had a 0.2 swing today where we
went
down. Yeah. So there's a lot of uncertainty. I think right now the risk is to the downside with mortgage rates.
Yeah, I would think so.
To get worse, right?
And get worse, to go up.
Worse to get lower.
Worse on price.
So risk downside in terms of not price, home prices, mortgage rates.
Got it.
Like
all right.
5.9, I think that makes sense. All hell breaks loose.
Yeah, that's where I go with this, because I played this out in my head the other day live on one of my live streams. I'm like, I really think rates retest 5.99. I know the spring selling season, the inventory's not coming. I know people talk housing market, luxury's broken. There's the middle, but that first time entry level home, it's so scarce.
Yeah.
And if we get a 5.99, we already saw what happened. I'm like, this could get bananas. This could get crazy for first-time home buyers. It could be really tough.
There's not much inventory there on first-time home buy. I mean, I look at realtor.com in the area I live. There's just not much.
There's nothing. Do they have offer review dates back?
Yeah.
They have bidding wars back. This is all entry-level stuff, right? Luxury still broken. It's
such a bifurcated market. There's just
exactly.
It's hard to write about it and cover it because there's just so many different pockets that are seeing so many different things and so many different price tiers seeing so many different things. I will say one wild card right now is credit lending.
Yes, I agree. Yep.
So, and this is a little out of my knowledge base. And I don't have a great way to track it. And I'm trying to find out right now. This is what I'm doing. I'm going around talking to Goldman, Morgan Stanley to figure out how I can best figure out how the story moves. But Morgan Stanley put out a note today and they said, based on the events, there's an increased likelihood of credit tightening and it'll take several months to play out, is what they said. The piece does not mention housing once. The piece does not mention residential once. It does mention commercial real estate and office space. And so I don't know right now if what could happen to credit tightening for residential and housing necessarily.
So I can tell you, having past experience
what have you seen?
So again, I have 20 years of experience of this. 2 of my weekly experts are in the business. And I put this out there today and they validated and pushed back. There are 3 lending markets. There is the commercial lending market, think office, retail, multifamily, that big stuff. That stuff's about to get super tight. LTV's coming down. Banks don't want to lend. And heaven forbid you're trying to refi out a bridge debt. Good luck. That is going to be some of the hardest stuff to refi. They don't want to lend. They're full, right? They're too concentrated. It's going to be hard. People are going to take write-downs. Banks are going to take losses. It is going to be messy. We are in the first inning of commercial pain. Second, there's investors in residential. Think houses to fourplexes.
1 second.
No problem.
Pause it.
It's okay. This is real life, man. I don't edit videos. I like you I like you being a dad. It shows you're a human being.
He decided to get into the gum. He's too young to get into the gum.
Yeah.
Okay.
Sorry, Leo. No gum for you yet. So again, where I was going is commercials in the first inning of real pain. And again, a lot of the pain is because Lance, they suffered the same residential pain. Short-term debt, bridge debt, variable rate debt, bad assumptions, all of those things. Then there's lending to houses and fourplexes called residential. That is going to get more expensive and harder to get. And then there's residential. It's going to get easier. First-time home buyers, easier because there's a willing and ready buyer that's going nowhere called Fannie and Freddie.
Well,
my lenders are telling me we are going to lightning speed applications through that pipeline because everything else is harder. So that's what's going to be happening.
Yeah, so it'll be interesting to see what happens. Yeah, and you know, again, this is out of my knowledge area, and I got to do more reporting this week to kind of figure it out and figure out what the right metrics are to watch. Goldman does put out a residential real estate credit tightening chart, which has shown that things have gotten tighter, you know, over the past year, but not crazy. So it'll be interesting. And yeah, the note says commercial real estate, office space, and that's already a part of the economy that is just hurting and is going to take many years to play out. Actually, in 2020, I met with Neil Kashari 2 times to chat about the potential for a future financial crisis through residential real estate. Or not residential, sorry, commercial real estate. Like if that could be possible, especially office spaces. Because at the time, 2020, that's when, you know, we had work at home initially.
Vacancy. Yep.
Yes. And so, you know, his view was anything like that probably wouldn't have too much of an impact financial system because it would take so long to play out.
Yeah.
But in the piece, I highlighted mid-sized banks, which are that's where commercial and the office space falls. It's
exactly. Regional banks are 50% of the volume. That's what people don't get. They're huge.
And so MMT Bank and Zion Bank and a lot of these were just off the charts with commercial. And so that'll be something to watch heading forward.
Big pain.
What we've seen now with some of these venture capital focused banks.
Yeah, it's going to be wild. There's a lot of concentration, which, you know, works really good in a rising market, but can come back to bite you as a market changes. And office is in trouble. One of my experts, we did an exercise 2 weeks ago where we took a $25 million San Francisco office building and we tried to estimate what its current value is given rents and vacancy. And we came up with a guesstimate of $8 million.
Wow.
Yeah. So there's going to be some significant haircuts. Lance, if somebody wanted to read the pieces that you're putting out, how would they follow you? And please mention your Twitter file because everybody needs to follow you.
Yeah. They can find me at News Lambert and they could Google Lance Lambert Fortune and find my articles.
Awesome, buddy. You do a great job. All things housing. Thanks, buddy. Bye, Leo.